So good morning to our respected chairman, Dr. Sanjiv Goenka, Vice Chairman, Mr. Shashwat Goenka, all the managing directors, CEOs, and CFOs of our companies, and our esteemed guests from the investor community, a very warm welcome to the RPSG Group Investor Day 2025. Can we have a round of applause as we begin this? Thank you so very much. So today, we are really excited to walk you through our performance so far, share what's next on our strategic journey, and give you a glimpse of the growth opportunities ahead. Today, you'll hear directly from our leadership team, gain perspective on key opportunities, and engage in discussions that will shape our way forward. We look forward for your insights and to a productive session ahead. Ladies and gentlemen, before we go ahead, we have a RPSG Group video to show you. So can we have the AV, please? is us. We are everywhere. Atra, tatra, sarvatra. This is us, Sanjiv Goenka Group. Can you have a louder round of applause, please, please? This made me more enthusiastic. All right, now it's time for us to hear from Mr. Shiv Sehgal, President and Head Capital Market, Nuvama Institutional Equities. He'll come and share a few words with us. So everybody, welcome on stage, Mr. Shiv Sehgal.
Good morning, ladies and gentlemen. Firstly, on behalf of Nuvama, I would really like to welcome and thank the prestigious and distinguished RPSG senior management team. It's indeed a privilege and an honor for Nuvama to be hosting this for the second year in a row after the success of last year. And I also welcome all our valued investors, potential investors, and our friends from the sell-side community for making the trip today. And on a very lighter note, let me also just thank the senior leadership team. After almost 2 months of gloomy days, they have brought a ray of sunshine to this lovely city as well. So thank you so much, sir. I think as Benjamin Graham famously said, and I think the markets constantly remind us, that in the short run, the market is a voting machine, but in the long run, it is a weighing machine. I think Benjamin Graham and Mr. Warren Buffett has famously re-quoted this over the years, which reminds us that true value is actually built upon true vision, discipline, patience, and partnerships. With that note, I think it is a privilege for Nuvama to be partnering with the RPSG Group, and we are very keenly looking forward to all the interactions throughout the day, as most of the investor community has been looking forward to this day for the last couple of weeks. And I think it is indeed, I'll try to keep this short and sweet, it is indeed a privilege for us that Dr. Sanjiv Goenka sir, Chairman sir, and Shashwat, Vice Chairman sir, for giving us the responsibility once again. And I think everyone is here to hear from you and the management team, so thank you everyone, and we look forward to the interactions. Thank you, sir.
Thank you so very much, Mr. Shiv. All right, ladies and gentlemen. With a legacy of over 200 years, RP Sanjiv Goenka Group is one of the fastest growing business conglomerates, spanning a wide range of businesses such as power, chemicals, IT-enabled services, entertainment, FMCG, media, sports, education, and infrastructure, with a vision to be a dynamic conglomerate driven by sustainable growth, efficiency, and innovation. Today, we are delighted to have among us Dr. Sanjiv Goenka, Chairman of the $8.5 billion RP Sanjiv Goenka Group, having presence in 60+ countries, 100+ offices, over 55,000 global workforce, and over 1.2 million shareholders. Dr. Goenka is a visionary leader who has redefined industries and continues to inspire growth, innovation, and excellence. Dr. Goenka was the youngest ever president of the CII and also the youngest ever president of the Indian Chamber of Commerce. He has served as chairman of the boards of governors at IIT Kharagpur. Dr. Goenka has been honored with several prestigious awards, including the Banga Bibhushan Award in 2015, for his contribution to West Bengal, Businessman of the Year by Hello, Hall of Fame in 2016, AIMA bestows Business Leader of the Year 2021 and the Hurun Visionary Business Leader Award 2023. He has also featured among India Today's 50 most powerful people for 7 consecutive years. Ladies and gentlemen, I request all of you to join me in welcoming the chairman of RP Sanjiv Goenka Group, Dr. Sanjiv Goenka, on stage with a huge round of applause. Warm welcome, sir. We're also delighted to have with us Mr. Shashwat Goenka, the Vice Chairman of RP Sanjiv Goenka Group. Mr. Goenka is spearheading Group's digital transformation, clean energy transition, and expansion into next-gen businesses. Mr. Goenka chairs CII's Eastern Regional Council, leads FICCI's Young Leaders Forum, and has served as the youngest president of the Indian Chamber of Commerce. Mr. Goenka is an economics graduate from the Wharton School, and now I request you all to join me in welcoming the Vice Chairman, Mr. Shashwat Goenka, on the stage. Now, I would also like to invite the senior leaders of RPSG Group companies to join us on stage. Please join me and give a warm welcome to Mr. Kaushik Roy, Managing Director, PCBL Chemical Limited. Mr. Ritesh Idnani, Managing Director and CEO, First Source Solutions Limited. Mr. Vikram Mehra, Managing Director, Saregama India Limited. Mr. Rajashri Banerjee, Group CFO and Executive Director, Finance, CESC Limited. Mr. P.R. Kumar, Managing Director and CEO, NPCL Limited. Mr. Suresh Kalra, CEO, Aqua Farm Chemical Limited. And last but not the least, Mr. Sandeep Kashyap, CEO, Renewables. Let's everybody once again welcome all our leaders with a warm round of applause. And now, it's my honor to invite Dr. Sanjiv Goenka on stage for his inaugural address. Everybody, once again, let's welcome Dr. Sanjiv Goenka himself on the dais.
Thank you, and good morning. It's a pleasure to be here. It's a pleasure to be with all of you. It's important for us to interact and communicate with you and to be with you, to keep you posted about developments at our end and to take suggestions from you as to what we could do better. This is the plan as it stands. It may get revised upwards as we move along. And we are going to invest for exponential growth, for scale, but more importantly, for profitability and for higher return on equity. In the past, our paradigm was about 15% return on equity. We are now looking at 20% at the very minimum. We've grown 3 times in terms of revenue. It translates into 200 plus action points across the entire group, which is what we monitor. And these are granular. We are decently capitalized at this point in time. I will walk you through 4 of the principal companies, and Shashwat will walk you through our big thrust, which he heads, that's renewables, plus the new age growth companies. I'll begin with power. We estimate a PAT growth of 2 times, from 1,400 crores to 2,800 crores over the next 3 years. Since last year, in the last 12 months, we've had a few favorable developments. In no order of priority, each one is important. In CESC in Calcutta, we have been able to effect an increase in our power rates, which yield an additional 750 crores per annum, translating into about 8.2%. I remember when we met last year, many of you had this question as to whether this is possible, whether this could be implemented, whether it would be implemented. It has been done. We talked of cost savings. 650 crores of cost savings have been implemented. 55 crores a month is what we are getting effectively from the month of May onwards. So that is in the bag. At Chandrapur, we had a PPA for 225 megawatts, which came to an end. And we now have entered into a new agreement, which translates into 100 crores extra to the bottom line. In Noida, we got a multi-year tariff proposal through, which gives us an additional 170, 180 crores per year of bottom lines. And a post-tax 700 plus crores of additional recovery for the past. So just these translate into roughly 1,600 crores of cash flows additional annually, plus a one-time 700 crores for Noida. We are investing significantly in renewables. 3.2 gigawatts will come into production over the next several months. The plan is to go up to 10 gigawatts over 5 years. Shashwat's going to talk much more about it. The operating cash flows grow faster. It's faster than PAT growth. And this supports the growth or enhancement in capital expenditure. Our total gross block in CSE is 33,000 crores. It took us the first 125 years to get to 33,000 crores. The next 5 years, the investment plan is 33,000 crores. There is plan to get into solar manufacturing with a 3 gigawatt solar cell and module manufacturing, the entire ecosystem, which is, say, between 2,500 to 3,000 crores. We have started or initiated work on a battery storage plant in Calcutta and Noida. Again, when Shashwat speaks about it, he will tell you that the first gigawatt module will be operational next month. The first 3.2 gigawatts of hybrid renewable energy will come into our own distribution networks. So this becomes good from our own network perspective. It becomes good from the generating entity's perspective. Chandikar, this is the first few months of operation, literally 3 months now, 4. And we expect to be profitable from year 1 onwards. And we are going to participate in more privatization opportunities as they come along. The most notable one is going to be the one from Uttar Pradesh, where the RFPs are expected within October. That's large. 2 distribution zones being split into 5 opportunities, 5 licenses. We want to bid, and we hope we will get 1 or 2. And that could be a very big area of growth. So it's high on cash flow, high on profitability, high on capex. As far as PCBL Chemical is concerned, it's twice revenue growth, thrice EBITDA growth, 5 times PAT growth. That's the broad plan. It comes from a combination of things. There are several expansion projects which total about 3,200 crores. We add a 90,000 ton expansion at our new Tamil Nadu plant, of which 30,000 tons is just about ready and 60,000 tons by the end of this financial year. This will give us an additional EBITDA of about 150, 160 crores. A 1,000 ton superconductive line at a cost of 60 crores, which would actually give us an EBITDA of about 90 crores. In our presentation, you saw the entry into acetylene black, 60 crore investment, EBITDA of 40 crores. Another brand new 150,000 ton carbon black plant in Andhra Pradesh at a cost of 1,100 crores, which we expect to commission by 28, an EBITDA of 250 crores. A 50,000 ton specialty black plant costing 400 crores with an EBITDA of 90 crores. The most aggressive, the most breakthrough kind of investment, that's the nanosilicon project. Our pilot plant will be ready in 3 months, and the phase 1 of the commercial plant in 28. The total capex is about 500 crores over 2 phases. We expect EBITDAs to be 1,350 crores. And let me state that nanosilicon, this will be probably the only capacity which will be available outside China. So this would be fairly significant. It's a kind of breakthrough. It helps in terms of powering the EV batteries. And what I can say at this point in time is that this technology will produce this nanosilicon at a much lower cost than anyone else produces at this point in time. Aquapharm has capacity expansion planned across different products, a total capex of 600 crores, which will lead to an EBITDA of 600 crores. We have a total capex of 3,200 crores. The cash flow from the combined operations will be 8,000 crores. Additional working capital will be roughly 1,000 crores. So net of working capital, 7,000 crores. At the end of this period, we will get to a very healthy debt equity ratio of 0.9 is to 1 or 0.95 is to 1. I come to First Source Solutions. It's a company which has shown remarkable progress over the last 12 months. But the next 3 years are even more remarkable. I'm confident that it will be. A 2 times revenue growth, a 3 to 4% improvement in EBIT margins, and this will translate into 2.5 times PAT growth. In the past, we had a situation where we had like one major win in a quarter. Last year, we went to 3 major wins a quarter. This year, we are hoping to take that up to between 4 and 5 major wins a quarter. Our sales pipeline is at 1 billion, which is the highest that we've ever had. Last year, we had ACV wins of $450 million. If I were to just very simplistically put this is at roughly, say, 18% margins. This itself translates into additional 800 to 850 crores of contribution per annum. And we expect the minimum run rate for order books to be about $100 million per quarter, and that's on the conservative side. Our newer contracts are focusing on offshore, a greater focus on offshore delivery. As you are all aware that the onshore margins are lower than offshore, and the higher the percentages of offshore, the higher the margins. And over the next 3 years, on the total company portfolio, we expect 50% to come from offshore. That's a steady shift that we are doing. We targeted a list of 80 plus accounts which have significant growth opportunities. We developed a detailed plan to not only develop pipeline of the transformational opportunities, but also cross-sell. We invested a lot in SG&A. And with that, and in addition to that, we expanded our portfolio of capabilities and our domain. So our theme has been un-BPO. We are not your conventional call center. We are AI-led, we are domain-led, we are solutions-led. This is what has yielded very good results for us in the market. This is the thrust that we will continue. We expanded into Australia, we expanded into New Zealand. We have 2 dedicated AI innovation labs, one in Melbourne, one in UK. We added 17 new logos. This is the highest quarterly addition in new logos ever. We are now seeing what we can do to improve margins in addition to getting more revenues. So it's a question of shifting the onshore-offshore ratio. It's a question of reducing attrition. It's adding more solutions to our customers. Increasing the number and average size of large win deals. We've identified a set of 37 margin drivers. Simplistically put, it's driven by digital transformation, Gen AI, and right shoring. Just to share some data, attrition reduced from 43% in 23 to 35% in 24. And in the first quarter of this year, it is 26%. For every 1% reduction in attrition, you save about 1.8 million per year. It's a very broad mathematics. We've done acquisitions. We acquired QBSS in May of 24, which is in medical coding, denial management, and clinical documentation. It gives us access to the US healthcare market. We acquired Ascensos in September 24 for 42 million pounds. This adds high growth retail and e-commerce into our portfolio, and it has long-standing relationships with high street retail brands in UK and South Africa. We acquired past due credit solutions in 2025 for 22 million pounds. It's focused on debt recovery. We acquired Acune AI. This is a specialist in AI services. We will continue to look at tuck-in acquisitions which give us access to either large customers in our existing domains or knowledge in newer domains. AI becomes a very major area, a tool which we are going to use for growth and margins. I come to Saregama. It's again a company which has to keep reinventing itself all the time. We are in the field of entertainment, of which music is the major component. So over the next few years, the plan is 2.5 times profit growth. We are investing heavily in marketing, in content acquisition, in analytics, and we are extensively using predictive AI. We have about a 25 to 30% in, this is the market share in new music content. We are focusing on youth. We are focusing on content. We are an IP-led company. So music is, of course, the major component. But short-form videos, 30 second, 60 second, 90 second, 5 minute. And we've expanded the distribution reach to 400 million subscribers, stroke followers. And this is with a focus on the youth. A large focus on live events. Diljit Dosanjh was the biggest artist event held in the country in the past. You'll see more events from us. The big growth comes from not only Hindi music, but from regional music. And we have expanded significantly into Bhojpuri, Gujarati, Malayalam, Telugu, Haryanvi. And this is helping us grow. It also expands margins because margins in regional products is higher than Hindi products. We recently acquired NAV Records. This is the Haryanvi catalog. It's one of the largest Haryanvi music players. It has 6,500 tracks and 24 million YouTube subscribers. And our YouTube views have gone up at a CAGR of 50% in the last 5 years. Our 10 songs, 10 major songs released in 25, crossed 100 million views on YouTube. We exclusively manage 250 influencers, having a follower base of over 140 million. So this is the ecosystem which we are trying to expand in. But the bigger growth potentially comes from paid music subscriber. That penetration currently stands at 1%. It is actually 13% in China. We expect Spotify and Saavn to turn pay. Whether it will happen in 6 months, 12 months, 18 months, but it will happen. And now let's take a conservative number that even if just 5 crore subscribers adopt paid subscription, it means an additional revenue of 6,000 crores. 5 crore subscribers into 100 rupees per month into 12 months. And half of that is the music industry's share. 30% of the music industry share is Saregama share. So the music industry gets 6,000 crores. Saregama gets 1,800 crores. So this, we cannot predict when it will happen, but we are very confident that it will happen at some time within the next 18 months. Once that happens, this becomes the next huge profit unlock for the company. So this, in a nutshell, is where we are and where we plan to be over the next 3 to 5 years. High growth based on high contribution capex, based on technology, based on AI, based on green, based on everything that's environmentally friendly, and everything that adds substantively to the bottom line. So this will take us to roughly about 18,500 crores of EBITDA, which currently we are at 75,000 crores of market cap. If you get to 2.8 times EBITDA, this takes you to roughly, and hopefully if we grow faster, multiples will change, but this takes us to close to 2 lakh crores, about 185, 190. Several people asked me before, what is the plan on sports? When do we monetize it? No plans of monetizing at this stage. But if the indicative values of RCB are any indication, we've done brilliantly on our investment. I'm going to invite Shashwat to share details on the renewable energy space and the FMCG space. Thank you.
A very good morning to all of you. Our target at RPSG in the immediate term is to get to 2 lakh crores market cap over the next 3 years. And this 2 lakh crore ambition has been broken down into macro-level strategic moves. This is backed up by numerous specific strategic and granular operational steps which have been identified and are under implementation. And each company later today will highlight to you in detail what we are doing. We are investing for exponential growth, for scale, and for higher return on equity. Today, I would like to talk to you all specifically about 2 sectors, the renewables energy sector and the FMCG. In renewables, we are setting up capacities of 3.2 gigawatts by FY29 with an ambition to get to 10 gigawatts by FY32. We have applied for connectivity of 7.6 gigawatts already and have secured connectivity for 3.8 gigawatts. These connectivities are in high wind and solar states of Gujarat, Madhya Pradesh, Rajasthan, Andhra Pradesh, and Karnataka. The first 300 megawatts will be commissioned by the end of this financial year, which is March 26, followed by 1 gigawatt to be added every year up until FY29. Investment for this first phase of wind-solar hybrid projects is about 23,000 crores. And in the first phase, wind will be 1.7 gigawatts and solar 1.5 gigawatts. For our wind projects, we have already signed framework agreements to the tune of 3.5 gigawatts with Suzlon, Inox, and Envision to secure supply chain of WTGs. For solar generation, 3,000 acres of land is already acquired, and agreements for 5,200 more acres are in different stages of signing. We have 1.2 gigawatts of projects in advanced stages of implementation, with PPAs already tied up. The total investment for these 1.2 gigawatts is 8,734 crores, yielding an annual revenue of 1,200 crores. The first of these is a 300 megawatt solar project, which we have signed with CESC. This will be commissioned by March 2026 in Badla, Rajasthan, and construction is on in full swing. The next is a 450 megawatt co-located wind and solar hybrid project, again signed with CESC, commissioning of which will be in the third quarter of FY27. This is in Mandsaur in Madhya Pradesh. And the third is a 450 megawatt wind solar hybrid for NPCL, which will be commissioned by the fourth quarter of FY27. The solar site is in Deshraj in Rajasthan, and the wind site is in Ralla in AP. For all of these sites, construction is under progress. Beyond the first 1,200 megawatts for our internal DISCOM requirements, we have also participated in other tenders like SECI, NTPC, UP NEDA, etc. So the 3.2 gigawatts will give us an annual revenue of 3,174 crores per annum, and the EBITDA of 2,875 crores. In renewables manufacturing, we are investing 3,000 crores to set up 3 gigawatts of cell and 3 gigawatts of module manufacturing. The first gigawatt of module manufacturing will be ready in Jaipur in October, which is next month. And another 2 gigawatts of modules will be ready by the end of calendar year 2026, with a total outlay of 350 crores. The 3 gigawatt cell line will be commissioned 2 years from today, with a capex of 2,400 crores. This will be either in the state of UP or Odisha. Today, we are negotiating with both the states, and whichever state gives us the higher capital subsidy, we will go with that state. These projects should give us an IRR of upwards of 20%. Shifting gears to FMCG, today our net revenues for FY25 was 560 crores. In the next 3 years, we project this to be 3.3 times this revenue. So in essence, what we are saying is by FY29, we would be at a net revenue of 1,850 crores, and at that point, overall FMCG will be at break-even. This growth will require an investment of 450 crores over the next 3 years, which will be met via dividends received in the holdco. Our strategy for FMCG is multi-pronged, spread across 3 large categories: foods, personal care, and herbal wellness. Foods is a 60,000 crore market, which is growing at 12% CAGR. Personal care is a 50,000 crore market, growing at 11% CAGR. And herbal wellness is a 45,000 crore market, growing at a 15% CAGR. For us, each of these businesses will be individually profitable by FY29 as well, with the largest, which is 2Yum, which is our snacks business, which will be profitable at a scale of 1,000 crores net sales. So with that, I'd now like to conclude, and we are all open for questions. Thank you.
Thank you so much, Mr. Shashwat Goenka. Okay, now, as Shashwat said, that we are open for the Q&A. So everybody, please share your questions. Here we have all the leaders right in front of you. So yes, we can begin. We have the mics rolling already in the audience, so let's start. You can raise your hand and we'll present you the mic and you can ask your question. Who's going to start? Okay. So can we have the mic right in front? Yeah, yeah.
Thank you, sir. I think I'll kickstart the proceedings. You did mention a lot of synergies and improvements coming on the AI space, whether it is Saregama or First Source and other group companies. Just a quick overtake on that as well for the audience, if you can. Thank you.
On AI, I'm going to ask Ritesh and Vikram to respond.
So there's obviously a lot of action and activity that's happening on the AI front pretty much every week, even since OpenAI launched ChatGPT in November 2022. And already it seems like that was a moment of AI history, just given the pace of advances. From our vantage point at First Source, the way we are responding to it is taking this head on. There aren't too many times in the history of organizations and in industry sectors that you see these number of shifts that play out. And today, I think we're in the midst of multiple concurrent shifts. On one hand, there's the uncertain macro. On the other hand, there's the technology shift with AI. And then there's the anthropological shift with 5 generations of people in the workforce. If you look back in history, normally what that does is it gets 2 kinds of responses. Either people play on offense or people play on defense. And normally, again, if you go back from a history standpoint, large companies tend to play on defense. They're reluctant to cannibalize. They tend to protect the core. From a First Source standpoint, we're using the current opportunity to our advantage. We're at a nice size and scale where we're not too small that we don't get a seat at the table. We're not too large that the pangs of bureaucracy come back to bite us. And therefore, in some sense, our play to integrate AI into everything we do is to take it head on and play on offense. Our vertical domain depth and bringing technology contextualized to the domain, coupled with underwriting business outcomes, are, I think, 3 elements of that secret sauce that are allowing us to grow at a faster clip compared to the rest of the market itself. We're using AI not to layer on what we do, but it's actually pre-wired or integrated into everything that we can do. So we're trying to reimagine the process ground up. And that's critical as opposed to putting a Band-Aid fix on an existing process itself. One final point that I will make is, which I'll cover in my session a little later in the day, our view is that the labor arbitrage era, which spawned the IT services industry, is over. That was an era of faster, cheaper, better. Taking broken processes and giving them a shelf life, or broken software and giving them a shelf life, and that's past its sell-by date. We are firmly in the technology arbitrage era, and there are 4 key attributes that I think are important for success in that era itself, driven by AI. Number 1, vertical depth. Number 2, technology contextualized to the vertical. Number 3, the ability to underwrite outcomes. And number 4, the agility and speed of response, just given the pace of change. These will become the key attributes to succeed in our minds in terms of what's coming down the bucket itself. So that's how we are trying to respond to it in every part of our business itself.
Vikram?
I'll give you specific examples here. We people have been using predictive AI for the last 3 years, and the result of that is that our hit-to-flop ratio, which can be easily checked from the market, is the highest in the market compared to everybody else. All other competitors of ours are actually depending on human, and we are using predictive AI to more and more move the company from human brilliance to machines coming back and telling us what's going to work and what's not going to work. On the generative AI side, we are doing both offense and defense. From the defense perspective, it's important that the large LLMs should not be allowed to train on our music without going out there and taking a license from our side. So there's a lot of lobbying work which is happening on that space with the government of India, in India, and also working with some of the international governments. While on the offense side, we are using generative AI to reduce the cost of production for videos that we people are building today. One of the, if I may say, drawbacks that or the weakness we have in Saregama is that all the catalog that we people own pre-2000, we own all the music rights, not the original music video rights. We are using generative AI now to create videos for all the songs of the bygone eras, whether it's the era of Mohammad Rafi or even S.D. Burman's music. We are creating new gen videos using generative AI at a cost which is far, far lower. Even on the audio side, Saregama has tied up with IIT Bombay to go back and say, can an LLM be created out here which is actually trained on our own music so that copyright infringement is not a problem? And can we generate music by giving cues like, can I have a Barish Ka Gana like Gulzar? And it will be trained on our own music. Saregama is uniquely placed out here because no other company in India has got such a large catalog of music sitting with them so that we can train an engine only and only based on our music.
Yeah, I have a question for Shashwat and two questions on FMCG. So first is of course on GST, we saw the rate cuts and obviously long term it is quite positive. My question is on the in the short term, do you see challenges in four things from a overall execution perspective? One is the trade has inventory and almost 40-45 days inventory could be there. So could that be a challenge? And in the near term, lot of the packaging material is already printed. So that I think the FMCG sector is canvassing with the government to put the sticker, etc. So do you see that as a operational challenge? Do you see any big challenge because of that? Apart from this, inverted duty structure, I think in FMCG, in the personal care and HPC, that could be a challenge. In your group, is that an issue you are facing that some of the raw material is at a rate of say 12% or say 18% and the finished good is at 5%. So any insights on that? And Q2, could there be destocking for you and for the industry? Because overall grappling issues. So your views on these four short-term challenges.
So I think the GST rate cuts will definitely help in increasing consumption significantly. And as far as we are positioned today, especially in the snacks market where we are selling at 5 rupees, 10 rupees and 20 rupees, the idea here is that the consumer is value conscious and so therefore we will pass on that benefit to the consumer. In the short term, you had a question around packaging material and can we do the labeling on top through a stickering. So this is a conversation that the industry is having with the government today. And we are hopeful that we will come up with a viable solution so that FMCG companies are not left at a lurch. And on the inverted rupee structure, I think this is not new. This has been a concern even earlier as well, where some of the products were at, some of the raw materials were at higher GST rates versus the output. And this is an ongoing conversation again that we keep having with the government. But the composition of those raw materials is very small, so the actual overall outcome, at least for us, is not significant.
Sure. Second and last question on FMCG will be last 2-3 years for the sector has been quite challenging. And because your company is largely in the unlisted space, if you could tell us that 560 crores, is it as per your initial expectation, say 2-3 years back? And second is whatever can go right has happened by the government and by the weather god for FMCG. So do you see that finally now the FMCG growth rate will come back to a more respectable growth? And your plan is for a 3.3x in FMCG revenue by FY29. Is there any M&A angle here or it's largely to the organic route? Thanks.
So starting with the last question first is the 3.3x growth that I spoke about is purely on organic growth from the 3 segments that we operate in. So no M&A included in that number. And I think on... Sorry, what was your first question, if I may ask to repeat?
Yeah, absolutely. So in terms of the 560 crore FY25, is it as per the expectation? And in terms of the growth rate for the sector, do you think now we can come back to a good growth? Because the monsoon has been good, GST, the income tax rebates and the food inflation, everything under control.
So while the industry has been growing at an average of 10 to 12%, if you see our growth rate over the last 3 years, it's been close to 25 to 30%. So in that sense, we are outperforming. Last year for us, FY25 was a year of correction. So we grew at about 12 to 13%, whereas the industry grew at 8 to 10%. This year, we are already projecting double of industry growth at 22%. So I think for us, growth rates will be higher than market growth rates. And as you see India is a country where over 65% of the population today is under the age of 34. And a large chunk of this is coming into the consumption class. And as we move to a Viksit Bharat, as we move to a developed economy, there'll be more disposable income in the hands of consumers. So the next 5, 10, 15 years, you will see this playing out, where a lot of consumption will start to increase.
Thank you.
Thank you.
Yes, mic at the back, please.
Hi, this is Shashadri Sen from MK. Thank you for the very strong opening remarks. I have 2 or 3 questions. I'll go one by one. I'll start with the overall group balance sheet. There are very aggressive plans for asset growth throughout the group. I know that at this stage, the balance sheet is in fairly good shape. Just want to give some color as to where do you think leverage would go? How do you cope with the overall debt that you're planning, and overall looking at how you're financing at the group level and at the individual company levels?
I'm a very debt-averse person. Early in my professional career, the family was joint, and that time, 40 years ago, 35 years ago, we grew by debt. It was something that gave me sleepless nights. Ever since, I've come to a very strong thing that at no point will the group debt go beyond 1.5:1. We will grow less, but we will not let our debt go above. The entire planning is based on that premise. And what we are forgetting is that over the next 4 years, we will have close to about 40,000 crores of cash flows. So you have internal accruals, plus you sit on cash reserves at this point in time across various companies. And then there will be a certain amount of debt. So the debt equity will continue to be a fairly healthy level. So there might be 1 quarter or 2 quarters where it might go beyond 1.5:1, but it will come down immediately.
Thank you.
And this is not only true at a group level, it will be true at a company level also.
You answered my follow-up. The second question is on execution. These are very aggressive plans across diverse businesses, many of which are open to a lot of macro environmental risk. 6 months ago, if we tried to predict what the macro situation would be, I don't think any of us could have predicted that we'd have 50% US tariffs, lower GST, a possible India North with China. And all of these create moving parts for many of your businesses, CESC, PCBL. I just want to understand at the group level how your, and the group structure is now seems to be that the individual CEOs managing each business. At the group level and at the individual company level, how do you monitor execution? How you protect yourself from these macro risks? What course corrections do you take? Just some overall comments and color on all of this would be, because that to me over a 3-year period will be key. If you execute, then your ambition of the higher growth will come through.
Well, if you look at the last 3 to 4 years track record of execution, we have been bang on time. Literally everything we have executed has been on time or ahead of schedule. So there is no reason to believe that we would not. And when we make a certain forecast, we keep a certain contingency in hand anyway. So it's not that there will be no surprises, there would be, but there will be positive and negative surprises. And when you have a situation, you deal with it. So you can't plan at that point for this kind of a situation, but you deal with it when it comes. And you will have some positive impacts, you will have some not so positive impacts. And so the overall sum should be okay. And as I said earlier, we have, as I spelt out, My attempt was to get into details with each one of you to show how detailed and meticulous the planning is to get to where we are getting. Where are the contributions coming from? Where are we spending? Operationally, where do we intend improving? Now, if everything works, then the numbers will be higher than what we forecasted. And we have a full-fledged team now which monitors these 200 plus 250 actually initiatives on a regular basis across each company. So before anything really gets to a crisis situation, it's flagged, and the best brains in not only that particular company but across sit together and come to some kind of a solution and a path forward. So if you're looking at my confidence on achieving these numbers, I'm somebody who doesn't like to overcommit. You would have seen this over the last 10, 12 years, where we have never overcommitted. And that is the DNA, that is the way we would like to be. So we are talking of specific vectors. I mean, exactly, I've tried to spell out how much profitability comes from where. Yes, there might be some things here or there, but then we deal with it. So how much of the projected profitability or expansion is at risk? Maybe 5%. So, that is not significant.
Thank you so much. Thank you.
Okay, very importantly, we just have 5 more minutes, so we can have just 2 more questions. So, yeah.
So Sagar here, this is mainly regarding our listed holdco. So what are the plans regarding, sports monetization? I understand we are not planning, you are not planning at this stage, but what are the other things that could happen in that company, and how should we see a medium-term overview of the listed holdco, if you can give a gist of it?
Our focus, honestly, is on the verticals that we spoke about. And the holdco will be an incubation venture. So you will always have incubated ventures, which will do well, but then you will have new ventures, which will have losses to begin with. So it'll be a mixed bag, honestly. I mean, I'd love to say that profits there will grow exponentially. I think an incubation company, by its very nature, will not give, it might give capital gains over a period of time, but would not give huge profitability. So as far as power, chemicals, IT-enabled services, entertainment, these 4 verticals are concerned, I'm confident and would commit to very high growth at the bottom line level. As far as the holdco is concerned, yes, as and when the businesses incubate and they get listed, there will be gains, but it might take some time.
Thank you.
Okay, so now the last question, quickly, in case anybody has.
Hello.
Okay.
This is Debashish Mazumdar from Swan Investment. I think you can see me, right? I'm here. So I have 2 questions. One is around power sector and second one is for Source. So in case of power sector, we have, especially on renewables, we have seen a shift in the strategy that you are adopting. Earlier, our renewable energy focus was completely to feed our distribution business. But from last quarter onwards, we are seeing the shift towards, bidding for SECI projects and NTPC projects. Earlier, our stance was these projects were not IRR accretive or ROE accretive for us. So just wanted to understand what has changed in this new strategy.
The environment has changed. And whereas, say, a few years ago, when we took that approach, the technology on the CapEx was not stable, and there were improvements every day. Today, we do believe it has come to a fairly stable level. And whereas you might see improvements, but it will not be that significant. And therefore, it is worthwhile investing. And secondly, even for distribution companies, more and more distribution companies are opting for renewable power. And going forward, you will see 40% or thereabouts, 35 to 40% of the total demand of any distribution entity being met by renewable power. And therefore, that's a unique opportunity. And more distribution companies are getting privatized. And with the recent changes in the Electricity Act articulated by the central government, you cannot have regulatory assets being carried on beyond 3 years. So all these make sure that collections at a viable tariff for distribution entities will happen. If that happens, they will pay generating entities. So therefore, the whole sector dynamics and environmentally has changed.
How do you find the bidding environment and the tariffs? Are you comfortable with that?
You know, it is what it is. It's competitive. And that's what any bidding environment would be. But at the end of the day, if you produce competitively, our right to win has to come at the generation stage. If we have the right to win there, then we can pick and choose where we win, because we will be best positioned to win.
Understood. And where will be this 3 gigawatt of cell and module will be housed?
So, I mean, the umbrella, I mean, it'll be in Purva, right? So it's going to be in Purva. And
so it will come under CSC then?
Yeah, all power thing comes under CSC.
Okay, understood. So the next question is for Ritesh. If you see for last 1.5 years, the majority of the narrative around AI is it is going to impact BPO the most. But if you see the BPO, today the industry leading performances is coming from the top 3 BPOs of India. Even if you see the globally BPOs are doing well. So what exactly is the dilemma? And I'm asking this question from the perspective that you are also thinking of un-BPOing is your business. So if you can just help me to connect the dot, please.
So it's a good thing, right? The business is doing well, on a lighter note. But I think if you take, when we launched un-BPO, and I kind of referenced this in my first response itself, the last 25 years of this industry has been built on headcount scale, process, predictability, standard services. That's been the labor arbitrage era. And if you think about where we are moving to, today customers do not want just lower cost, but they want higher impact. They do not want just standard services, but they need deep domain insights leading to business outcomes. When we decided to launch un-BPO, we said this is not just a tweaking of an existing playbook, but it's a fundamental rewrite of how work gets done. And if you look at the underlying tenets surrounding un-BPO, we said the standard boundaries between IT and BPO are starting to blur. They're not vanishing, but they're starting to blur. The traditional boundaries between front office and back office are blurring. 75% of this industry has been built on a time and material model. You add headcount, you get revenue. It's a very linear correlation. The industry, however, and customers today are demanding more and more business outcomes itself. So the traditional services model, which was built on labor, is under stress. The traditional software SaaS model, which is built on per user, per seat, is also under stress. And that's why the era that we are in right now is a services as a software play. Now, if you go back in time, typically large incumbents tend to take their time to react. They tend to be reluctant to cannibalize some part of their business. And some of that, I think, creates opportunity for players of our size who have a competitive moat which is built on the back of vertical domain itself. So what's creating differentiation for us in the market? I think even in the BPO space as well, I don't think it's a uniform growth that you're seeing. You're seeing players who've got a competitive moat based on vertical depth that are starting to do better, as opposed to somebody who might be just in a horizontal function like finance and accounting or HR or procurement, or they might have just a pure play contact center business itself. So you're starting to see market differences in different cohorts of players. At the same time, what you're seeing consistently as a pattern, independent of the macro, larger companies are citing either macro softness or are growing at a much slower pace. And that's, by the way, that's expected when you see how history rhymes or repeats itself. So in a way, we think that this presents an opportunity for players like us to outshine and grow at a faster pace compared to the rest of the market, and use the opportunity to take share from either larger incumbents or smaller, undifferentiated players who are everything to everybody and therefore nothing to anybody. I think that's what, in some sense, is creating the opportunity, the market opportunity, and the right to win for us.
Sure. One last question on platformization of services. We, as an IT industry, participants are waiting for very long for this non-linearity to happen. And it seems because of AI implementation, the software writing time period and cost effectiveness has come down significantly, and that is kind of helping us to get into that platform as a service mode. So if you can help us to understand that because of this platform as a service, do we need to, because we largely dependent on time and material, we as an industry and FSL also. So is it like some of our business will go away and over a period of time we will catch up, but initially we have to take the burnt?
So you've got a few questions in that, but I want to state one point at the outset. While 75% of the industry is on a time and material basis, the corresponding number for us is close to 60% of our business is non-linear today already, right? So we think we have a little bit of a head start compared to the market in terms of understanding how to price deals which are linked to a business outcome itself, right? So as an example, one of the largest deals that we won, the largest deal that we won last quarter in the history of the company was with a mid-size healthcare payer, right? If you look at the construct of that deal, it's linked to a business metric which is called as a per member per month, which is a very traditional metric in the healthcare payer space. It's linked to the administrative loss ratio. Our ability and our comfort in pricing on a per member per month is linked to the confidence that we have based on the depth and domain in the vertical itself. Now, our view is that this is where the industry has a fair amount of work and a catching up to do to understand what it takes to price beyond time and material. Even today's fixed price that IT services and other companies talk about is nothing but really an effort-derived number. It's not really a true fixed price itself. So I think there are opportunities out here which we think we can take advantage of in our endeavor to bring both technology as well as operations together. I think the second shift that is also critical out here, which is one of the tenets of UnBPO, is we can't do this all ourselves. So the partner ecosystem will become extremely critical in terms of how we compete in the marketplace itself. And there, our role will become one of an orchestrator, where we are able to bring different players who bring different capabilities, complementary, to render the outcome itself. And therefore, the ability to orchestrate and bring those partners together will become a core muscle that organizations will have to build and execute on as well. And this is another area that we think we have a little bit of a head start in terms of how we are competing in the market. So these are some fundamental shifts that will need to play out to deliver technology-enabled services itself.
Great. Thank you so much for answering my question.
Thank you so much, everybody. This was indeed an insightful and engaging Q&A session. Thanks, Dr. Goenka and all our leaders for enthusiastically participating in this Q&A session. Now I request all of you to get together for a group photo. And of course, I request our other group leaders to kindly join in for the group photo. And requesting all of you to kindly be seated, because in a short while we'll be starting with the main track session of CESC Limited.